Welcome to Catalyst. I'm Madison Mills. 30 minutes into your U.S. trading day. Let's get you the three catalysts that we are watching this hour. First up, we break down the outlook for international equities amid growing calls on Wall Street to sell American assets. Plus, we discuss the state of Fed independence as Trump reignites his fight with Powell to cut interest rates. And we'll look at the catalyst needed to boost Tesla shares as the company gears up to report first quarter earnings while the stock has been under pressure. Half an hour into the start of U.S. trading, let's get you a check on the markets. Taking a look at the major averages here, you got a little bit of a rebound this morning, if we can even call it that. You've got your S&P 500 up about 1.5%, your tech-heavy NASDAQ up about 1.8%. All of the Mag 7 names currently up. The question is, will that momentum be able to continue as we kick off the Mag 7 earnings cycle with Tesla reporting after the bell today? But let's take a look over at the bond market as we have seen that Sell America trade happening in the market, putting pressure on the dollar yesterday. We're now seeing bonds catching just a bit of a bid. You've got your 10-year yield down about 3 basis points, your 30-year down just about 5 basis points right now. Finally, let's take a look at Bitcoin moving to the upside, up a little over 3.5%, holding over 90,000. I want to bring in friend of the show, host of the Trader Talk podcast and chief market strategist at Slatestone Wealth, Kenny Pulkari. Kenny, great to have you as always. I loved in your recent note to us, you say investors have not given up.
So that was referring to capitulation, right? Mm-hmm. Capitulation happens when everybody is just giving up. They're throwing everything out the window, including the kitchen sink. They've just had it. Mm-hmm. Yesterday's action, while it was uncomfortable and kind of anxious, there were no signs of capitulation. There was no panic in the market. So that suggests to me that, investors are kind of, while it's uncomfortable, they're riding this. They have not given up, and so therefore they're still finding opportunity.
So then, what do you make though of, just humor me for a second with the Sell America thing, right? Dollar down, sell off in bonds, sell off in U.S. stocks. It's not supposed to happen.
No. So they're creating a lot of angst and chaos in the market just because there's all this uncertainty around Trump and around trade and around tariffs, around China. Oh my God, China is creating all this angst, right? And so therefore, what you have is you have investors fleeing into gold. Look what gold has done. It's now trading at 3,500, I think, this morning. Mm-hmm. It ticked up through 3,500. Mm-hmm. And that's just a sense to me that people are just flocking to the ultimate safe haven trade. And so what that means is that they'll sell the dollar, they'll sell stocks, they'll even sell bonds just because there's more safety in gold. Period, the end.
And it's interesting, too. I want to get to some of your stock picks because I remember thinking after the back-to-back double-digit rally, you really got to be a stock picker to beat the averages. You still have to be a stock picker in this environment, correct?
Yeah, you do. You absolutely still have to be a stock picker. But look, the market has had a dramatic move lower. Mm-hmm. There are some great names, mega-cap names across a range of industries that have really suffered a dislocation in price. Not because their thesis has changed, just because when people get nervous, they sell what they can and they sell it really quickly just because they want their cash, which then presents an opportunity. So you look at names like, large cap, mega cap names across the space: Walmart, Costco, Coca-Cola, Johnson & Johnson, IBM, Procter & Gamble. Those are all names that are core holdings for a lot of portfolios, and that if those names go on sale, like in this recent downdraft, then you can buy some of those names at a discount. There's absolutely no reason as a long-term investor that you wouldn't buy those names because nothing has changed for those names.
No recession concern for some of those names?
So I'm not in the camp that we're going to have a recession. So part of that reflects me, right? If I was in the camp that thought we're going to have a recession, then I would be more cautious, right? Mm-hmm. Or I'd be waiting a little bit longer. Mm-hmm. I'm not in that camp that we're going to have a recession, right? We don't have 2 quarters yet of negative growth. Mm-hmm. Unemployment is still at historic lows at 4.1%. Mm-hmm. Incomes are still rising. At least that's what they tell us, right? So none of that points to a recession.
And when it comes to tariff exposure for some of those large cap names, you've got Amazon on this list.
Yeah, but Apple. I think the whole tariff thing is I think there's some short-term pain because we're going through that, but I don't think the tariff thing is going to last, 6 or 8 months. I don't. I think, we probably have another couple of months of kind of this turbulence. Look, J.D. Vance tells us that we're supposedly getting a deal with India, or at least the framework of a deal with India today. If we get that will be a positive, right? We just need some balls. We need some some not home runs, but some base hits, right? We need a first base, a second base, in order to get the market to settle down. You don't necessarily need a home run in every one. And if J.D. Vance is right, and we get the framework of a deal with India, then others will look at that. Investors will see what that looks like. And then they'll start to extrapolate on what it could look like for other countries. And I think that's really what we need to get the market to settle down, which doesn't mean it's going to go straight back up. It just means it'll settle down.
Yep, and we're going to talk about exactly that, the movement in India later on in our show. Kenny, you're going to stick with us. Thank you so much. Appreciate it. Let's continue the conversation. Stocks and the dollar moving to the upside today, looking to recover from Monday's rout. The currency, usually considered a safe haven asset, sank to 3-year lows as the so-called Sell America trade intensified. Given the volatility, where can investors find opportunity outside of the U.S.? Joining us on that, Paul Idleman, Russell Investments Chief Investment Strategist for North America. Paul, great to speak with you this morning. It's been interesting to watch the flows because we have seen outflows from the United States, inflows to international equities. Where do you continue to see opportunity in terms of international exposure that's not already starting to be a little bit overdone?
Yeah, I mean, global diversification has been a big focus for us in 2025. And so I'd say two regions that stand out as being attractive here, in our view, are Europe and Japan. I think in the case of Europe, it's certainly been a performer year to date relative to the United States. But even with that outperformance, relative valuations on a forward price to earnings basis are trading at still a 30% discount to the US market. That's about as cheap as Europe has been since 2001. And I think we've started to see some incremental cyclical catalysts for European fundamentals here as well. Obviously, the ECB has been cutting interest rates, which is a positive. There's been increased fiscal spending from Germany. We're starting to see a credit impulse creep in through the banking system in Europe, which correlates pretty nicely with GDP growth. And that combination or recipe of cheaper valuations and improving cyclical dynamics is often a positive one for investors. I mentioned Japan as well. I think that's another area where, on the back of corporate governance reform, we're starting to see better usage of cash from Japanese corporates towards buybacks, improving margins, improving return on equity. And Kenny was talking about a potential trade deal with India earlier. I'd say Japan's also towards the front of the pack towards a possible trade deal with the United States in the coming days. And if we get a positive that could be a kicker for both Japanese equity market performance, but also global equities at large if we start to hit some of those singles that Kenny was talking about and start to improve risk appetite in the market again.
And also just curious how you're thinking about declines in the U.S. dollar, currently on track for its worst month since 2009. How does that frame your investment decisions, particularly when you do look at asset classes that might be impacted by those currency moves?
Yeah, I mean, as a U.S. investor, that obviously improves your all-in dollar returns for non-U.S. equity market exposure. So it's a consideration. We've seen pretty unusual dynamics in the dollar recently, a bit stronger today, but I think some question marks around U.S. exceptionalism and the soundness of U.S. institutions after the attacks on the Federal Reserve yesterday that have just, raised some questions around the U.S. over the short term. But again, if we can start to change this tone, no news is good news around attacks on Fed independence today. If we start to get some trade deals as well and improve the tone on trade policy, I think you could see some stabilization in dollar dynamics, and again, that broader risk appetite for global markets.
And Paul, my guest host Kenny has a question for you. Kenny?
Hey, Paul, how are you? Good morning. Let me ask you a question. Just like when the dollar is strong and it rises and we come to earnings season, everyone gets concerned because that the whole dollar and they transfer foreign profits back, then it's less money and blah, blah, blah. The reverse is true. As the dollar is weaker and U.S. large multinationals transfer those profits back, it's actually a benefit to them. Correct? Yep. And so what do you see? So that will take some of the sting out, I think, in terms of all this nervousness, because having a weaker dollar certainly benefits them. What's your view on that?
Yeah, absolutely. That's a big dynamic for multinationals if you're thinking about the outlook for S&P 500 earnings over the coming quarters. Roughly speaking, every 10 percentage points of weakness in the trade-weighted dollar would map onto a boost of call it 1 to 2 percentage points for S&P 500 earnings growth. So there's a lot of push and pull here, some potential headwinds from trade policy, some potential offsetting positives from the dollar. I'd say on balance, our expectation is that corporate earnings growth is likely to moderate from very strong run rates at the end of 2024. But I think as long as we can avoid a recession, which at the margin is our base case here, that's an environment where S&P or earnings growth can probably deliver, call it mid-single digit positive results, which I think would be rewarded into this market after the significant sell-off that we've already seen year to date.
Right. I think that's exactly true. Let me ask you one more question based on kind of your conversation with Madison when you came in. Given this environment, are you suggesting that the investors should now overweigh their exposure to the foreign markets? Or because typically for me, when I think about foreign markets, I think about 10% of the portfolio should be in foreign markets. Are you suggesting in this environment that people might want to raise their weighting in their foreign exposure?
Yeah, I think there's two layers to that conversation. Number one, we do think that strategic global exposure is really important from a diversification perspective, and that's certainly been a theme and feature of the market so far in 2025. And I'd say at the edges, a modest overweight to areas like Europe and Japan could be appropriate, and that's a theme that's a part of some of our global equity strategies here.
Really quickly, Paul, when you think about barbelling strategies, do you barbell using U.S. Treasuries in this moment or cash?
Well, I think the front end of the curve is looking most attractive to us in terms of valuation. It's still a pretty shallow and flat curve from a historical perspective, and you're getting that safe yield in an environment where tariffs directionally could be stagflationary. I think they would protect portfolios in a recession scenario, but those inflation consequences could possibly challenge the long end and would make points of the curve like the 2-year point or the cash potentially a little bit more attractive for that sort of diversification and ballast.
All right, Paul, got to leave it there. Thanks so much. Appreciate it.
My pleasure.
And Kenny Pulkari is going to stick with us. We've got all your markets action ahead. Stick around. You're watching Catalysts. We're looking at some of today's trending tickers. CoreWeave, defense stocks, and GE Aerospace making some of the biggest moves today. First up, we have CoreWeave. Wall Street analysts initiating coverage of the cloud provider following its IPO in March. Among the 5 major brokerages covering the shares, Goldman Sachs setting the highest price target at $54, while JP Morgan has the lowest at $43. Jefferies has a buy rating and a $51 price target, while Barclays has an overweight rating and a $48 price target. The stock was priced at $40 in its IPO. You can see those shares moving to the upside here, but still below where they were at on that IPO day. Kenny, how do you think about a stock like CoreWeave in this environment?
Listen, I think CoreWeave is going to play a major role in the middle of the AI space, right? So I think it's a name, while it's relatively new in terms of its IPO, I think it's a name that you should have some exposure to. And I think when you look at the different ratings that the firms have, and Jefferies just came out today with their rating, right? That the stock is a name that you want to have exposure to, you want to have it in your portfolio. Not a ton of it necessarily, but I think it's going to benefit certainly in this AI environment.
All right, something else that we are watching in this environment, defense stocks getting dragged by tariff uncertainty today. RTX issuing disappointing guidance, warning that President Trump's tariffs could pose a significant risk to operating profit. Meantime, Northrop Grumman missing first quarter expectations and cutting its earnings forecast for the year as costs mount for its next generation B-21 stealth bomber. Meantime, Lockheed Martin reporting a higher first quarter profit and reaffirming its full year forecast boosted by resilient demand. And Kenny, something that's been keenly a focus over the course of the administration so far is government spending, obviously something that impacts a lot of these defense names. How do you keep up with that?
So listen, it's like anything, right? You pay attention to what's going on. You see what these companies are guiding on, where their expertise is. Look, they're all in the same space. Northrop Grumman and Lockheed are in the same space. Lockheed came out with great earnings. Northrop was a little bit cautious. I think you have to see what the differences are in terms of the role they play within the aerospace and defense sector, which I actually like as a sector in general. And then you have to go from there. I think the negative guidance from from the two companies this morning certainly is what's causing the pressure on that. It's just that investors are not sure if they're giving negative guidance and they're still not they feel unsettled about it. Then the first thing investors are going to do is hit the sell button.
Yeah, absolutely, and something that we will likely see throughout this earnings cycle. Finally, though, GE Aerospace topping first quarter earnings expectations. The jet engine maker seeing gains from its defense businesses and commercial engines and services unit. The company says it is working to offset the impact of President Trump's tariffs with price increases, cost controls. This does come after the CEO met with the president earlier this month to explain how a, quote, tariff-free regime has benefited the aerospace supply chain. You can see those shares moving up. This is exactly what we were just talking about,
exactly,
Kenny.
Right, right.
Kind of, no, just an ability for a company to come out and say, we have the ability to withstand the impact of these
Correct,
tariffs.
and they just did, and look what's happening, right? Investors will reward that.
I think it'll be interesting to see whether or not investors reward companies that prove that they can offset these tariffs versus those that say we've got two potential options.
Yeah, and so
like
I think that'll be. Look, United Airlines came out and said it, last week. They gave two different scenarios. If this happens, then this is what our guidance could be. But if this happens, then this is what our guidance is going to be, right? So it's very interesting. But companies that come out and say, just like GE said, they have the ability and they can do it, and they're sticking to their forecast, that's going to be rewarded.
Absolutely. And by the way, you can scan the QR code on your screen to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Just want to quickly do a check on the major averages here because we are seeing stocks hitting session highs here. You've got your S&P 500 up over 1.5%, your tech-heavy NASDAQ up 1.8%, the NASDAQ 100 also hitting session highs. Fascinating to see what's driving the tape right now. Consumer discretionary and financials are the two biggest gainers in the market right now. Among the top performers in consumer discretionary, the number two is Tesla. That'll be reporting later today. Coming up, we're speaking with a former U.S. trade representative and advisor on how the Trump administration's trade negotiations are progressing. Stick around for that next on Catalyst. Vice President J.D. Vance speaking in India today, calling the U.S.-India trade partnership a win-win, saying, quote, Americans want further access to Indian markets. This comes a day after Vance met with Indian Prime Minister Modi, the White House saying the two leaders made significant progress toward a new trade deal. As the U.S. reshapes its global trade partnerships, I want to bring in Brad Setzer. He is the Council on Foreign Relations, Whitney Shepherdson Senior Fellow, and former U.S. Trade Representative Senior Advisor. Brad, great to have you on here. We were just talking about how investors seem optimistic today about these negotiations with India. In your view, how optimistic can investors afford to be with these conversations and potential negotiations with India while the record-breaking tariffs with China still remain intact?
Look, I think we still need to see progress on some of the bilateral deals, see what the contours of a deal that is acceptable to this administration, what those contours are. India is important. It's not an enormous trading partner. It's a modest trading partner. But I think the bigger issue is that for negotiations with Japan, with Europe, with Korea, it's not yet clear what the U.S. really wants. That's the reports. That's what the Japanese are saying after meeting with President Trump, Besant, the senior team in D.C. That's what the Europeans said after meeting with the USTR last week. There needs to be a little bit more clarity about what kind of deals the U.S. is willing to do and whether these deals are about taking off all the tariffs or whether they're just avoiding these so-called reciprocal tariffs with a 10% baseline tariff basically being non-negotiable.
And we're getting headlines here. The Minister of Finance over in Poland saying he does not expect a U.S.-EU tariff deal this weekend. More broadly off of that, Brad, I'm curious how you would rate these negotiations. Like, what inning are we in these negotiations as we are getting headlines in about negotiations potentially not coming with some partners, whereas you got the vice president over in India? Where does that leave us right now?
My view is we're in the first inning of these negotiations. Maybe we haven't even started the game, because what the U.S. has consistently failed to do is articulate exactly what it wants from our key trading partners. There's very clearly a willingness on the part of Europe, Japan, Korea, Vietnam, India to see what we want, to see if it's possible to do a deal. But an actual concrete deal first of all, take clarity about the U.S. ask. Then it takes a decision on the part of the trading partners about whether they can meet those asks. We already know some U.S. demands, say changing European food safety regulations, are just not going to fly in Europe. So I don't actually think the hard negotiations have really started, because I don't think we're at the point where both sides know what they need to do if they want to get a deal.
And my guest host, Kenny Pulkari, has a question for you, Brad.
Well, so Brad, here's the issue with that, because I do agree that we're in the early innings. I'd like to think that we're at least in the first inning, but here's the issue with that. If this continues to drag out, not something I think the administration really wants to see. I think they are trying to get, like I said, a base hit, 1 or 2 base hits, get somebody on base so that they can start to build on it. Holding it up and pretending like we don't know what we want, dragging out the conversation is not going to help the administration, nor is it going to help voters or investors, really, as we become more frustrated with the lack of information. So my guess is at some point it's got to start to pick up speed, don't you think?
Yes, I mean, presumably you'll have some deals start to take shape a little bit before the deadline, the 90-day deadline. But remember that a typical comprehensive trade deal takes a year and a half to negotiate. So I think at the best case scenario is you have something which looks a little bit like an interim deal, and then there's an agreement not to put the reciprocal tariffs on at the end of the 90-day period. A really big deal, which requires changes in other countries' laws and practices, it just simply cannot be both negotiated and implemented in a 90-day frame. There are ways to work around that.
Right.
But I think the broader point is I think the administration has been spinning a bit too hard here. They want to say there's a deal. They want to say a deal is coming. They want to kind of prop up the stock market, give the stock market a little bit of hope. But the actual negotiations don't seem to be really moving nearly as fast as the administration's rhetoric. So you have this consistent gap between what's coming out of the White House and what our negotiating partners are saying, where our negotiating partners are saying they don't yet know what the U.S. wants.
Well, I think someone in the administration really has to light the fire, because in a year and a half we're going to be in midterms, and I think the last thing the administration wants is to be in the middle of this mess at the midterms. They want to be able to go into the midterms saying, here are the deals that we have so far, here's how it's worked out, here's how it's benefiting us.
I mean, sure, but it's also the case that part of the difficulty here is that President Trump hasn't given clear instructions, in my view, to his negotiating team about what he personally wants, about what he personally thinks is a good deal. He wants to bring bilateral trade imbalances down. The problem his negotiators face is removing a lot of the well-known trade barriers wouldn't get you anywhere close to that goal. So I think there's a lot of, there'll have to be a bit of give on all parties' side. But it also will have to be a bit of give from the president. The president seems to be seeking an outcome that realistically isn't typically the result of a normal trade negotiation.
I do just want to end on something specific out of China, buying soybeans from Latin America, canceling up to $13 billion of soybean purchases from the United States. Does China have a broader capability for repositioning off the back of these tariff policies than the U.S. originally gave it credit for?
I mean, in some sense, yes. I mean, one thing we know is because we fought a trade war with China in Trump's first term, and because of the structure of China's government, China's been preparing for this kind of trade confrontation for the past 4 or 5 years. So they have a detailed playbook. They are using that playbook. Buying soybeans from Brazil is very much part of that playbook. Not taking deliveries of orders from Boeing is very much part of that playbook. Not buying U.S. LNG and energy is also clearly part of that playbook. We also, in a sense, have to figure out whether we can absorb the shock of 150% ballpark, 145 tariffs on most of our imports from China. For many businesses, 145% is just a really big change in the price. And I think we may have overreached. It's a tariff that's too high for a typical business to pay. And in that case, we may find ourselves with some supply shortages if we don't unilaterally adjust our tariffs. So I think the administration maybe overplayed their hand a little bit with respect to China, but the The reality is also China's a state-directed economy and has big state importing companies that buy oil, that buy oil seeds, that buy aircraft, and they can be directed to stop purchases at any time. We knew these kinds of retaliatory steps would be coming.
So Brad, put a bow on this for me. If our investor audience is listening and they're saying, okay, we just heard this guy tell us the game hasn't even started, where does the game end over the next couple of months when it comes to tariff negotiations?
Well, I think the Trump administration needs to make a couple of very big decisions. One, are they negotiating just to take away the reciprocal tariffs, the ones that were announced on Liberation Day? Or are they also willing to do deals that will get rid of the 10% baseline tariff, the tariff that was applied to countries, even which we have balanced trade? We don't know the answer to that question. The Japanese have said, in order to get a really big deal, we want all the tariffs to roll off, the bilateral tariffs, the reciprocal tariffs, the 10% tariff, the auto tariffs, which we haven't discussed. So first of all, how big a deal can the administration do? Second, are they willing to accept some interim deals, steps in the right direction to avoid an increase in tariffs on 90 days, or not quite 90 days, 80 days from now? A full comprehensive standard trade agreement just can't be reached in that time, but you can always string out the process. And I kind of expect the most likely outcome is we end up stringing out the process. And then I think the third big issue, because the biggest component of the tariff hike right now is the tariff on China. Do they find ways to either get some kind of modest de-escalation with China, or do they unilaterally just have to pull back some of the tariffs, as they did on the tariffs on iPhones and certain other electronics, because the impact on the U.S. was judged to be too harsh? I think the China position, there's a realistic risk that emotion and the desire to retaliate and the fact that the president was frustrated that President Xi wasn't giving him a call, all that led the U.S. to kind of take the tariffs a couple of steps too far. And the administration may need to find a way to elegantly walk those back, because it doesn't seem like we're starting negotiations with China anytime soon.
Brad, thank you so much. Appreciate it.
Sure.
We're going to have all your markets action ahead. Stick around. You're watching Catalysts. History may be somewhat repeating itself with President Trump's attacks on Fed Chair Jerome Powell. Trump's criticisms the past few weeks have echoed similar comments he made back in 2019. Here with those similarities and what's different this time around, we've got our Washington correspondent, Ben Werschel. Ben, great to have you. Tell us what you're monitoring in terms of whether or not we've seen this movie before.
For sure, yeah. We have seen this movie on a certain level before. There's a bit of a wash, rinse, repeat cycle here. I looked back, I wrote this morning about a sequence of events in 2019 that I think is illustrative here. Step one was the Trump administration announced new tariff plans. That time it was on China specifically. Step two was Jerome Powell gives a speech. That time it was in Jackson Hole, Wyoming in August of 2019 that suggested that trade uncertainty could be a factor in delaying rate cuts. Step three was Trump responding immediately in the days that followed with a wave of insults. That three-step process, you could sort of, is almost exactly what happened in the last week. You just have to replace Jackson Hole with Trump's speech last week at the Economic Club, or Powell's speech, excuse me, at the Economic Club of Chicago. As for how it played out in the months that followed, it was a lot of kind of more of the same of insults from Trump, but a declining to tested. As for what's different this time around, a few I'd point out. One is that the economy is in a very different place than it was in 2019. Powell in 2019 described the economy as in a, quote, favorable place. His speech last week, he described it as in a challenging place. And that there's a lot of measures that show that. And so that sort of changes the political calculation for Trump perhaps a little bit here. The second one, though, is that Trump has really moved aggressively to perhaps back up his insults with actions this time around. There's a case before the Supreme Court about firing independent heads of agencies in the government that could apply to Powell. We have to wait for that decision that's expected sometime this summer, whether that applies to Powell. But it's a different situation. But so far, at least, it's playing out. This movie is definitely repeating for certain.
Yeah, certainly a big question mark for financial markets that we'll continue to unpack. Ben, always great to have your insights. Thank you so much. Appreciate it. Recent threats from President Trump challenging the Federal Reserve's independence have roiled markets. The president demanded Powell preemptively cut interest rates now, calling the Fed chair a major loser on Monday in a Truth Social post. As Trump's rhetoric intensifies, where does that leave the central bank ahead of its May meeting? Neil Irwin, Axios chief economics correspondent, joining us now with more. Neil, is this about what RBC is calling a scapegoat for Powell, for the president scapegoating Powell here, or is it about actually firing him?
Look, this is an unpredictable president. He has fewer constraints around him than he did when he was previously in office. I would not put anything past him, but I think the one binding consideration here is that if the goal is to get lower interest rates, firing Powell might be counterproductive, or even trying to fire Powell. We've seen just in the last week, bond yields have risen because of greater uncertainty around the future of the Fed and the central bank independence. There's a real irony here that if Trump really wants lower interest rates, keeping Powell in place and maybe getting off social media might be the way to do it.
Well, talk to me, too, about the dynamics of the Fed that you obviously understand as someone who covers the economy. Just because you change the Fed chair doesn't mean you actually change the way the Federal Reserve votes on cutting interest rates.
That's right. It's a 19-person Federal Open Market Committee. They meet 8 times a year. The Reserve Bank presidents have kind of staggered terms. The governors have staggered terms. There are no governor slots coming open until next January, I believe, and then Powell's term is up in May. So, it'd be a slow process of trying to install his own people. So it's kind of like, what's the rush? It's going to take some time. Governors have to be confirmed by the Senate. What are you really gaining if you're Trump, if you try and inject this uncertainty around who's running the most powerful central bank in the world?
Yeah, actually, to that end, Neil, does this potentially put the Fed in a place where they feel politically pressured to not cut, because then it looks like there's a bit of a capitulation? Is that something your sources have said they're concerned about at all?
So look, we were talking about what happened last time in 2018, 2019. Jay Powell has always insisted that they not overcorrect, that they not adopt a stance of, well, the president says we should do this, so we're going to do the opposite. He says, take the facts as they come, take the data as they come. So look, if we start to get a recession and the inflation picture is stable or not as bad as some people are projecting, they'll absolutely cut interest rates, even though the president is saying exactly that. I think they want to see the data. They want to see the evidence. And right now, tariffs are a stagflationary shock. They are a supply shock that causes prices to rise, inflation pressures to rise, and growth to slow. They want to see which of those impacts is bigger, and they want to see that in the data before they act.
And Neil, my guest host, Kenny Pulkari, has a question for you as well.
So Neil, I'm in the camp, and I have been in the camp that I think the Fed should not do anything. I think rates at 4.25% are actually perfect where they are, considering where the economy is. All the hard macro data comes out fairly robust. Some of the soft data might be a little bit of a question, but I think Jay Powell's right. Cutting rates is not going to. If they cut rates 25 basis points, what's that really going to do for you and me and for the economy? In my mind, it's not going to do a whole lot, but all it's going to do is potentially then refuel inflation, which, while calming down, could easily be ignited again. And by the way, lower rates are also not going to help the housing market, because low mortgage rates are only going to cause housing prices to continue to go higher. So I think holding rates right here and letting everything settle down and watching the data unfold is exactly the right thing to do. And so while Jay Powell is going to do that, I think Trump needs to stay in his lane and just get out of the way and not carry on with this chaos.
Yeah, one risk is if they do preemptively cut rates like the president's asking for, that could cause long-term yields to rise very easily. We saw that back in September when they cut 50 basis points, and then yields actually rose in the ensuing weeks. If markets believe that the Fed is not serious about keeping inflation in check, you will see it in bond yields, and we've seen some of that the last few weeks with the trade wars. It's not like they can just turn a dial and magically avoid the kind of inflationary impacts of what we're seeing in the trade arena right now.
No, but the last two readings in CPI and PPI were actually lower, and that's a positive, and so everyone's complimenting that. PCE is due out at the end of the month. Let's see what that says. But to Jay Powell's point, I think he's being cautious, and rightly so, and I think he needs to just, honestly, I think he needs to just kind of put Trump in his place and ignore it and just do what he's meant to do. And I would hope there are people in the administration that are, saying to Trump, just stay in your lane and calm down.
Yeah, it's a interesting time. It's clear the president listens to a lot of people who have a lot of different views on this. Some who say, look, this would be a mistake. Don't take preemptive action. You can fill this job next May and put your own person in, and that's kind of the proper order of things. And you can do that without kind of being destructive to markets and confidence. If you try and rip off this Band-Aid early and try and get in a court battle, again, do you really want a thing where the Supreme Court is litigating, deciding who's in charge of the Federal Reserve, and it's in a state of uncertainty for weeks or months in between? No. That does not seem confidence inspiring.
Well, Neil, operationalize this for me a little bit, especially for those who are concerned. They want a central bank that is independent. What are the checks and balances in place that protect Fed Chair Jay Powell, as he would say, not permitted under the law for him to be terminated?
Yeah, the Federal Reserve Act is quite clear that Fed governors can only be dismissed before their term is up for cause. Courts have generally found for cause doesn't mean policy disagreements. It means malfeasance or something really over the top. So the question is, does the president have a unilateral ability to fire any kind of person in the executive branch? That's what he's arguing in the National Labor Relations Board case that's going to the Supreme Court, or is at the Supreme Court. He's fired FTC commissioners, which is also trying to overturn a 80-year-old precedent that goes back to 1935. Will he prevail in that in the courts? Will the court, if he does prevail, carve out the Fed and say the Fed is different? Those are things we don't know. All of it adds to a real atmosphere of kind of uncertainty around governance of this very important institution in the global economy.
Neil, I want to switch gears before we let you go and talk to you about manufacturing, which I know that you have reported on this morning, the Richmond Fed survey. Interesting results here. Manufacturers in the Richmond district saying they are already reducing headcount and expect to reduce headcount even further into the future. And I think amid the tariff war, maybe people listening to this show might be surprised that there's already a reduction in headcount in manufacturing, given that tariffs are meant to boost that sector. Talk to me about what your reporting has unveiled to you about the impact to manufacturing that these tariffs could have.
Yeah, the truth is virtually all manufacturing in the U.S. Requires inputs that come from overseas. And so if you are making things, assembling things that require inputs from around the world, suddenly you have either 10% tariffs, 145% tariffs from China, you name it, depending on exactly how some of these things shake out. You're looking at your inputs becoming a lot more expensive, and you're not sure if your customers are going to be there. There might be retaliation from these other countries if you export goods abroad. So that just adds this pall of uncertainty to the entire manufacturing sector. How it all shakes out over time, we'll see. But in the near term, this has been really disastrous for kind of manufacturing sector confidence. We see it in all the surveys.
Neil, thank you so much. Appreciate you making the time for Yahoo Finance this morning. Coming up, we're looking ahead to Tesla earnings out after the bell, the first major automaker to release results amid the looming tariff threat. That's coming up next for you on Catalyst to Ground. Tesla set to report first quarter earnings after the close today. It will be the first major automaker to report amid the looming tariff threat, also the first of the so-called Magnificent Seven. While President Trump teased a potential reprieve for autos last week, nothing has been confirmed. Plus, we heard from Mexican President Sheinbaum that no deal has been reached yet, but talks do persist between the countries. Joining us now on this, Nishit Madlani, S&P Global Ratings Autos Managing Director. Great to have you on here. Just curious if we could start off with Tesla here. What are you expecting? To what degree do you think that Tesla is or isn't a bellwether for the other automakers, just given how unique this particular stock is?
Yeah, first of all, thanks for having me. So I guess just to take a step back, look, we are in a very tough environment for EVs. If you look at just the market share losses that Tesla has had, Model 3 and Y combined, not just in 24, but throughout this year so far, despite price cuts, even though some of that was expected, we know that competitive pressure from tariffs is just going to make it very hard to stem volume and profit margin decline. Remember, Tesla hasn't had a major mass market launch since the Model Y, which was 5 years ago. So obviously on their last earnings calls, they had guided investors to new products, which is very important in the auto industry. They had talked about a more affordable vehicle in the first half of this year. And now with all the headlines around tariffs, it may be a little hard to make EVs affordable, especially if they're relying on parts outside the US. So they typically don't discuss product plans on earnings calls, but any color on timing and dependence on tariff relief will be a very crucial assumption for us for growth over the next few years. Because without a new, more affordable model, we do think that this will be a slower revenue growth here with a lot of pressure on pricing and profit margins.
Well, I guess that makes me think, about the outlook question for the other automakers too, whether or not we're going to see kind of a United Airlines approach in terms of offering dual guidance, or do you think that these automakers are really going to come out and attempt to convince investors that they can survive any headwinds from tariffs?
Look, I suspect it's going to be a mixed bag, right? There are companies that have a lot of exposure to imports, and some of them that probably are more exposed on the component side. So, I wouldn't be surprised if guidance is withdrawn in several cases, because the key assumption around the duration of tariffs is a big unknown. And to the extent that some of these companies will have a multi-billion-dollar impact on earnings, it's probably most prudent for them to wait and see how things go before committing to a guidance. And the other aspect is that there are mitigants, right? So it's not all negative. There are aspects within their business that are within their control. So to the extent those mitigants, such as cost reduction over and above what they've already announced, maybe some resourcing to the US where possible, and of course, some adjustments to inventory which might help them deal with pricing a little better than competitors. Those are things that we expect to get more narrative, more color on. But on specific numbers, it's probably going to be very difficult to get specific estimates from companies at this time.
And final minute left, but my co-host Kenny Pulkari's got a question as well.
Nisha, do you think that that a lot of this has already been priced into these stocks? Or do you think that investors are really going to be surprised if, in fact, they get either no guidance or cautious guidance? Do you think it's already? Where do you think investors stand on that?
Yeah, look, I mean, we're more focused on the credit outlook, right? As a rating agency, we're looking at the sector outlook being somewhat negative because of the shifting tariff policies and ultimately what it means for cautious consumer spending getting even more tight. So from our standpoint, we've already built in, light vehicle volumes, not just EVs, but the broader industry being down by almost 1 million units for next year. And then specific to EVs, we've lowered our forecasts for EV market share because we are seeing a lot of competitive pressure and it's getting hard for these cars to be affordable. So I would think most investors recognize that these are major challenges for the broader auto industry, but there's going to be tremendous pressure going ahead, even if you look at other headwinds specific to EVs on reevaluation of emission standards or repeal of these EV tax credits. All of that adds to more challenges.
Certainly a lot of headwinds to consider. Nisha, thank you so much for joining us. Really appreciate it. Huge thanks to Kenny Pulkari for joining me for the hour as well. To our audience, you can stay tuned for Yahoo Finance's special coverage of Tesla's earnings today at 4 p.m. Eastern. You won't want to miss it. Keep it up here for Wealth, dedicated to all of your personal finance needs next hour.